So here's the opening range retest trade idea that I'm talking about. Looking at the S&P right now, this is a 1 minute chart, but the yellow or gold lines are today's opening range. So today's opening range was 10.75 points. So the 50% retracement is 5.25 points, and you can find that here on that red diamond here. Anyway, the market did this, hit the pivot here, so forth. We're well after 10:30. Comes back up just before 11 a.m. and comes and hits the opening range low. So the idea here is to sell the opening range low. So right in this particular case, it was 33.75. So I'd probably put it a couple of ticks before that. And I'll show you why in a minute. But and then with your target down here, which is 28.50 or so. So you're about 5 points, looking for about 5 points of profit. Your stop would actually be above the opening range high. So in this case, you're risking 10 or 11 points, probably 11 points to win 5, which the risk reward is not good for sure. One of the things that you can look for, though, is days like this, where in this case, you had 4 pivots, then the market from 10:13 basically to 10:53. So in 40 minutes, it came shooting back and took a while to get there. So, those tend to be really good because if they kind of wore itself out over time, went a long ways to come get there. Usually your first hit is going to be profitable. And in this case, it was. Now, looking at the other ones, which we're going to look at in a second, they don't always line up like this. In today's case, they did. But if we look at the NQ, for example, this is around the same time. The NQ needed to come up to 12.110. It got up to 12.107.75, so say 12.108. So missed it by 2 points or 8 ticks or so. And then you can see again the red diamond here. That's basically exactly where it needed to get to your 50%. So you can see it bounced off there nicely. It needed to get down to 80.5. It got down to 78 and bounced. Now, these particular cases, this was you would have had to have about 9 ticks difference between what the actual opening range low was for you to get filled. I don't love these where it misses it just by a little bit, comes back down and does exactly what it's supposed to do, and then bounce. These are not areas that I would personally love, especially since if you're looking at the ES, it did exactly what it was supposed to do at that same time. So it extended it a little more. It actually hit its opening range low and then came back and gave it a winner, and it gave it a winner really quickly. So within 2 minutes, you're out of your trade. So these I don't particularly love, but they did win. So if you would have just stuck to the plan and sold it at 12.110, you would have got a win, and it took you 3 or 4 minutes to get it, and that would have been about 29 points or so on that. Dow, same thing as the NQ, basically missed it by about 4 ticks. Needed to come up to 92, got up to 88 on the minis, and I think the micros were 89. But you can see that again, that's the same time as the S&P came back down. Might not be able to see it, but the 50% is right here. Came back up. Again, if you would have held out and said, I'm just going to sell it at 92, you would have sold it there. In these particular cases, it missed it. So you needed to come down to 53. It got down to 56. So for me, for those 3 points, so I'm shooting for 39 points. It got 36 of them. I'm not going to risk all the way back up here for that. So worst case scenario, I'm exiting at break even in that particular case. So And if that was the case, I would have got stopped out here if I wanted to strictly go based on the official aspects of it. I would have stopped out there personally in my own trading. But as far as officially, it never hit the opening range above the opening range high. So you would have won the trade. It just would have took a little while. You would have got out at 11:18, and your entry would have been so about 20 minutes later, and you got about 39 points out of it. But these can work for the upside, can work for the downside. Here's a little more information on it that I just kind of ran over here. So this is kind of the instructions on the idea here. We draw the opening lines, NQs off a 3-minute chart, Dow's off a 5-minute chart, S&P's off a 5-minute chart. You can refer to the opening range video for the basics on the opening range. You draw the pivots on there. In my examples, there's a blue dots. You draw the retracements. In my case, it's red diamonds. And the idea behind this is that if the market goes up or down to the first pivot, then at some point it will come back up or down to the opening range low or high, which I just showed you. And you want that to happen after 10:30. So I don't take anything before 10:30. So if it comes down, hits first pivot, and then, at 10:02, it's back at the opening range low or high, I'm not going to take that particular trade. So I want it to happen after 10:30. Once it hits the opening range high or low, one or two things will happen. It'll either bounce off the high or low and go up or down 50% of the opening range, which I showed you in today's case for the S&P was 5.25 points. Each day is obviously going to be different, or it's going to go through the opening range. In this particular case example that I showed you today, it would go through the opening range high. Obviously, this would work on the opposite side as well. If the markets were up, hit pivot 1, and then came back down to the opening range high, you'd be buying it at that point. I just showed you some examples. It's possible to never retest for that day, but it's still valid for days in the future. So, you might not, market might go straight down or straight up and never retest that opening range. And if it does, it's still a valid opening range support or resistance, and I would still play it the same way, even if it didn't happen on Tuesday, but Thursday the market comes back down to that opening range from Tuesday for the first time, hits it, I'd be buying or selling depending on things. The way that I usually play it is I'm assuming that the opening range lines are going to hold and then it's going to bounce and go to 50%, like I showed you in today's examples. But the problem with this, of course, is your risk reward is not good. So you're risking 2 times whatever your reward is. So in today's example, for the S&P, I'm risking basically 10 or 11 points to gain 5, which isn't great. The win rate is fairly good, but again, you're probably going to want to pick your spots. Today's a good example of, the run came down a long ways. It came back up a long ways, was tired because it took so long to do so. And usually that's going to break and give you a win. Obviously not always. But you want to avoid the ones that are before 10:30. Also, days where, say, for example, let's say it popped down to the pivot, and then say this was after 10:30, and then within 2 minutes, you're back at the opening range low. That isn't something that I'm very confident in either. If the distance between the first pivot hit and back up to the opening range low, or again on the opening range high side, if it's very small time-wise, chances are that that's going to be a losing trade and it's going to just keep going. It's not going to respect it very much because it didn't take long to hit that pivot and then come back to the opening range low or high. So those are the ones to avoid. Obviously, you can cherry pick and choose, and if you find that it works well with another indicator that you're looking at, great. But you can look at those as retests. You can see in today's example that it really didn't matter what the 50% retracement was. They stopped there. They stopped at the opening range lows. Not all of them are going to do that. obviously, but it's something to put in your trading arsenal. Hope you enjoy it. Take care.